and surged back up near the $74 range. Yet its recovery rally was abruptly halted as the technical-driven momentum dissipated. In this report, we aim to shed light on the catalyst driving WTI's price and assess its future outlook. On Tuesday, the Red Giant released its trade balance report for the month of April, and that the data showcased that the country's ongoing reopening efforts may have started to lose momentum, hence raising worries for the country's recovery, alongside the prospects for increased demand for crude. More specifically, China's imports contracted sharply by almost 8% in April, signaling that domestic demand is weakening as crude imports waned by 16%, reaching their lowest level since the start of this year. For comparison purposes, March's crude imports stood at 22.5%. When it comes to the exports, the nation beat expectations, reaching the 8.5% level, yet the rate is almost half of last month's output, signaling that the economic recovery phase may not be going according to plan for the world's largest oil importer. Given the results, energy traders may have started to downgrade their optimistic outlooks, which had anticipated that China would be the prime driver for higher energy prices, particularly for the second half of the year, and rather indulged in some sort of short-term speculative behavior. At the start of April, energy traders were quick on their feet and scrambled to recalibrate their positions to reflect the surprise announcement of OPEC Plus for fresh output cuts. The oil cartel, in a sense, caught everyone off guard once again, as it broadcasted to the world its unyielding commitment and intervening and rebalancing the market whenever a so-called deviation occurs. During its unofficial ministerial meeting, the organization announced 1.6 million barrels of output cuts set to take place this month and will last for the remainder of the year. The voluntary cuts by OPEC Plus attracted criticism from Western nations, more specifically the US, whose envoys outright branded the decision as ill-advised, expressing forthright their disagreement with the decision. Even though the US and Saudi Arabia share a strategic trade alliance, the US does not have an implicit say into how the kingdom conducts its business. The relationship of the two nations has grown bitter over the past year, following the decision of the Saudis to cut oil production by 2 million barrels last October. Looking at the event in hindsight, we can conclude that the decision served as a bullish catalyst for oil prices in the short term, yet the momentum slowly dissipated and the market quickly diverted its attention towards fears of a recession as the Federal Reserve keeps on tightening to squash inflation and inadvertently suppresses the prospects for increased demand of crude.